This is Barry Knapp with Ironsides Macroeconomics. It's Sunday evening at about 5 o'clock Arizona time. I'm at the Fairmont Scottsdale Princess to speak at the Trader Forum to a bunch of head traders from various buy-side shops. I spoke last year, and apparently I was entertaining enough for them to ask me back to speak again this year. Um, Needless to say, I'll sneak in a little golf away from the snow in Vail as well. S&Ps are unched. 10-year Treasury futures are down 3 plus 30 seconds right now, following on the pretty good shellacking that the Treasury market took last week. We titled our note Stag Week. It was a little bit tongue in cheek. We're not really prone to talking about stagflation, but the point is that we had worse than expected inflation numbers and worse than expected retail sales, which is a little bit surprising. And it comes on the back of what we consider to be a fairly weak employment report the following Friday. Now, I know some will look at the headline and say, yeah, it was pretty strong. It wasn't strong. The aggregate hours index, total hours worked so far through the first 2 months of the year are flat. Retail sales through the first 2 months of the year in the control series are actually down. So we are off to a bit of a sluggish start. We realize the narrative of a growth scare hasn't really taken hold, but as we wrote the previous week with our idea that the quadrilemma revisited, and this idea that we might actually get a growth scare is worth considering. So we wrote about that. I'll get into a few more details about that. Then we wrote about prices stabilizing, albeit at a higher rate of inflation. And we tried to give a little broader term perspective about how things could settle in around 3, and it wouldn't be the end of the world unless the Fed decides it is the end of the world and pushes us off a cliff, either pushing too hard from below like they did in the 10s or try to do it again this cycle could cause problems. We then gave a preview to this week's FOMC meeting, gave some thoughts on China. We had an interview with CNBC Asian Squawk Box last week, and they asked us for our thoughts on China. We had to put them down on paper. We hadn't written about it much recently, so we added some thoughts in the note last week. They were brief, but we think poignant, and then gave up our wrap-up comments for the note overall. So, going back to this, data that we got last week and what it means for policy and the market's outlook, the immaculate disinflation, Fed being able to cut because they can, thesis took a real hit last week. It might have been easy to dismiss the January inflation numbers as noise, but when we got strong numbers again in February, it's a lot less dismissible. CPI, PPI, and core import prices, ex fuels, were hotter than expected as well. And if I'll come back to the inflation story in a bit, but the bottom line is inflation is not cooperating. We didn't expect it to cooperate. Ultimately, we did think that growth would slow in the labor market in particular, and we're starting to get that. So there were, a couple of days last week where small caps and banks were really under pressure. At the very end of the week, tech took a hit. But again, remember our scenario-based analysis. And we think this is a pretty important way to think about the risks and what could disrupt the current tech-led rally. Obviously, if the data doesn't weaken, we've got some 500 billion of extra coupon securities for sale in the second quarter. Bank of Japan looks like they may very well end yield curve control as soon as this week. A stronger dollar would not do much for the Treasury market. It would make Asian demand probably lower, and the banking system with a deeply inverted curve and a higher for longer Fed's going to hold the policy rate above 5% scenario, which we may very well find out this week is their latest summary of economic projections forecast. Again, that would weaken demand for Treasuries. So that real rate, 10's going back to 5%, led by real rates scenario we got a little whiff of last week, is a scenario where we could get a broad risk off. But in that scenario, we'd probably want to stick with the same game plan and buy tech and related sectors on a broader risk off. We're suggesting you should have some powder dry. Now, the scenario where growth slows as indicated by, flat total hours worked so far this year, retail sales that are actually down. If growth does deteriorate, in that scenario where the Fed gets on a fairly aggressive cutting path, even if inflation isn't cooperating because they're worried about the employment part of the mandate, that's the scenario where you could potentially buy small caps and banks. So two different scenarios, but worth considering here. We actually think that that is moving towards our quadrilemma, labor market weakening, growth weakening scenario. But obviously, we're going to need some more weaker data for that narrative to really take hold. So moving on to the inflation numbers, we started out with an argument about broader inflation volatility because the standard deviation of CPI is starting to come down quite rapidly. We've gone through, rolled through the worst of the shock. We had three decades where inflation volatility was fairly low. The 60s and the 90s in particular. 60s inflation averaged much less than it did in the 90s, but in both cases we had strong capital spending cycles, rich equity market valuations. Those were really favorable investing environments, and it was because, in part, prices were stable. In the 2010s, prices were also stable, but the Fed kept trying to push from behind to push prices up. And that created uncertainty with capital allocators, right? Businesses making capital investment because they were always worried about the flip side of when the Fed ended one of these programs and then the market would sell back off. You could see that recurring pattern through the first part of the business cycle. We'd get these rallies when the Fed launched, QE2, Operation Twist QE3, and then the equity risk premium would actually go higher through that period. Through that entire period, the equity risk premium of economically sensitive cyclical stocks went up, not down. So again, this is our point that the Fed could, get comfortable with inflation at a stable, slightly higher rate, and that capital spending boom that all the pieces of the puzzle are in place for could go on regardless. But the Fed's going to have to move away from this arbitrary 2% target they're so enamored with. So that's the broader perspective. But when you dig in the details here, again, near term, this is not going to make the Fed happy. You can't consider this just noise. Super core inflation, that's non-housing services inflation through the first 7 months of last year, averaged 0.21. It looked like wages were coming down, service sector inflation was coming down. The last 7 months, it's averaged 0.40. The last 2 months were a 0.46 and a 0.52. That's way too hot. We do think it will cool, but it's got to cool a lot, to get back to levels it was at pre-pandemic and convince the Fed that this isn't all about a tight labor market. So that's point number one. Point number two is rent of shelter. We had a very hot print in January of 0.6. It settled back in December. But again, over the last year, we're averaging 0.44s. That's a long way from a 0.25. And if you look at some of these things like the Zillow Observed Rental Index, they've stabilized only marginally below where they were pre-pandemic. And with supply having taken such a big hit, sure, there could be a period of soft rents here, but ultimately we think rental growth is likely to be stronger in the 20s than it was in the 10s. Again, problematic for that broader inflation story. In the meantime, all the source of disinflation the Fed was so excited about in the second half of the year, core goods, are turning back up. And you can see that in the import price series is a very good number. And you can see it in the chart that I have in the video version of this. And in the weekly, of course, the blue line at the bottom is inflecting back up on a 6-month annualized basis. That's core goods. And we didn't write about energy, but that's worth noting too, because spoken to a good friend of ours who runs an energy trading desk at one of the big banks. And there's a pretty good chance that we get a breakout here and crude moves substantially higher. So again, not particularly good news on the inflation front. So looking forward to next week. The big debate is, do we go with the summary of economic projections to 2 cuts from 3? Everyone's done the math. All we need is 2 people that were looking for 4 or 3 to go to 2, and then we're back at a 5% policy rate at the end of the year. While it's been widely discussed, we would remind everyone that in September, when the Fed intimated they were going to keep the policy rate above 5 for the next 15 months, the proverbial shit hit the fan. So this is a problem for the banking system if that truly is realized. That notwithstanding, we're more interested in that longer term dot, whether that starts ticking up, and more importantly, QT. Most market participants have it, we think, have it in their mind that QT is going to slow and this is going to be a good thing for risk assets. That's not what we think is likely to happen. We think the Fed is going to move, albeit at a glacial pace, running in the background sort of stuff, towards shortening the duration of the system open market account, which would be they only have 3% bills in that account right now. Treasury issuance is closer to 20. They should be letting all coupon securities roll off. If they have to lower the cap, they should be reinvesting in bills, go back to the bills only policy that was in place from effectively 1951 when the Fed Treasury Accord ended interest rate caps through the Bernanke QE1, and they really ought to move away from that. We then made an argument, sort of counteracting former New York Fed President Bill Dudley's editorial in Bloomberg last week, that in the absence of the Fed's balance sheet, he cited event studies, which we despise. Event studies, how much did it move on the day the Fed made the announcement? Those are nonsensical in our view. Broader studies about what the impact is, and then just common sense, right? Where were tens when the Fed raised to 5.25 in 2006? They were, a percent higher than they are today. Where were real tens? Significantly higher, another 50, 60 basis points higher than they are today. In the absence of the Fed's balance sheet, tens would be above 5, and 10-year reals or tips would be probably 2.5, 2.75. So again, we still think that the path of least resistance over time, as the Fed shortens their balance sheet, is towards higher back end rates, a bear steepener, and that to us is kind of key. Is if the Fed indicates, yeah, they're going to start shortening the duration of their balance sheet. Moving on to China, you can look at the note, but in essence, there's a chart in there that shows Shanghai Composite, which is state-owned enterprises primarily, earnings and revenues contracting, both in negative territory, earnings falling more than revenues, implying that margins are negative. The only data we find of really very much use that China releases these days is ordinary imports as a measure of domestic demand. That's running at about 2%, makes their 5% GDP target look nonsensical. We don't know how they get there without some big consumption spending package, tax package later in the year. They've been very reticent to do that. I know Mike Pettis, who's a real expert in China, thinks they may come around to doing that later in the year. But for us, it would take that in order to get us interested. So again, watch Japan this week. That could be big. And on balance, we do think we're moving towards the quadrilemma thesis that the Fed starts cutting aggressively because growth weakens, but we're clearly going to need some more weak growth numbers to be for the Fed to be convinced of that, and even that narrative of a growth scare to start taking hold. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.